Hi everyone and welcome to the very first video of this channel. This video is a part of a series I'm about to create to showcase how I approach financial markets, sectoral research and investment storytelling. My goal with this channel is simple. I try to dilute down complex financial topics and explain them in a way that's both insightful and in an easy to understandable manner. So whether you're an investor, an equity research enthusiast or someone who's curious about how money moves in an economy, then hit that subscribe button and stay informed. So, over the last few weeks, I have been closely following a sector that is important from an economic, societal, and investment perspective. This sector actually brings together aspiration, infrastructure, and inclusion all in one place. Now, if you ask yourself a very basic question, what is the biggest financial aspiration for an average Indian? You'll not be surprised to know that it is not to create a 10 crore investment portfolio. It is not to create another CRED, another Zerodha or Upstock. It is not even to retire early, but something far more personal. It is to own a home. For millions of Indians, owning a home isn't just another financial transaction. It's an emotional milestone. In fact, it will probably be the single largest investment they will ever make in their lifetime. And this dream becomes reality not through the help of their savings alone, but through the housing finance companies that comes into the picture to make the home ownership possible. So yes, in this video, we will explore the housing finance industry and its growth prospects. We will dive deep into the affordable housing finance segment and discuss about its key growth drivers. And finally, we will discuss about the fundamentals of some of the key players in the affordable housing finance space. So if this is very clear to you, then let's get started. Starting off with the demand dynamics of the sector, just take a quick look at this table. It gives us a clear picture of how household savings saves money in FY23. The total household savings stood at approximately 49.6 lakh crore, and of this, just 29% came from net financial savings like bank deposits, mutual funds, and insurance after accounting for the borrowings. A significantly large portion, nearly 70%, was invested in physical assets, primarily in the form of homes and real estate, and a modest 1% was saved in gold and silver. So this clearly shows real estate still continues to be the preferred savings avenue for millions of Indians. And that's exactly where these housing finance companies comes into the picture to support this growing demand. And if you think of these housing finance companies as just another retail lender, then you're missing out a bigger picture. And it's completely understandable because many fail to realize how deeply the sector touches life of an individual at a grassroots level. It's just not about homes. It's about inclusion. It's about empowerment. It's about giving countless families their very first step towards a better future. And this sector, by the way, is not small. As of March 2024, the total housing loan outstanding in India is over 33 lakh crore. That's around 378 billion US dollars. And this number, by the way, is expected to more than double over the next 5 years, crossing 81 lakh crore. And that's the scale we're talking about. An interesting fact to be mentioned, this sector has both backward and forward linkages with more than 250 ancillary industries. From cement and steel to furniture and labor market, this sector acts as a critical pillar for the economic development. But to everyone's surprise, this sector is still underpenetrated. In order to understand this, just take a look at an important metric: mortgage to GDP ratio. For India, it stood at 12.3%. And if we compare it with the global counterparts like China and US, which stood at 28% and 60% respectively. So this gap represents an immense untapped potential for the segment. And in any scenario, when the rise in per capita income is evidenced, housing affordability improves and access to credit expands. That's exactly why I believe we're likely to witness a surge in demand for housing loans going forward, unlocking opportunities not only for individuals, but for developers, lenders, and the broader economy as a whole. Now let's try to understand at a broader level who is behind the lender. To begin with, we have our banks. These are your typical players like SBI, HDFC Bank, ICICI Bank. They serve salaried individuals, low risk borrowers, and offer loans at a competitive interest rate. They control about 74.5% of the market. Moving forward, we have our large housing finance companies, and these are the companies like HDFC Limited, LIC Housing, PNB Housing. They specialize in home loans, but still prefer borrowers with formal income documentation. And finally, the affordable housing finance players, and these are the disruptors. But before we dive into the why part, let me paint a quick picture. By 2030, it is anticipated that nearly 600 million Indians will migrate to the urban areas. And this number, it's huge. But for most of these people, they're not looking for a 1 crore apartment. They want homes priced between 15 to 50 lakh. But here's the problem. They don't have payslips. They don't have the traditional civil scores. These are your typical people like kirana shop owners, gig workers, auto rickshaw owners, and even freelancers. If traditional bank says no to them, then who's there to say yes? And that is where the affordable housing finance companies comes into the picture. Now, these companies, they do something very smart. While traditional banks and large housing finance companies focus on salaried and creditworthy customers, these affordable housing finance companies focus on customers belonging to low and middle income segment of the population, that too from tier 3 cities and below. While traditional banks analyze an individual's creditworthiness using the formal CIBIL score, these affordable housing finance companies use as alternative data to underwrite their loans. Alternative data like your monthly rent payment history, your utility bill payment history, and in fact, they will analyze the cash flows of your business. So this creates a new way of assessing risk and expands the borrower base quite dramatically. And in terms of growth rate, with a 5-year CAGR of 21% between FY18 to FY23, affordable housing finance companies register one of the highest growth amongst its peers. And if you're curious about what's driving the growth, then let's move on to the key driver section of the presentation. To begin with, the biggest catalyst, we have the government initiatives. Schemes like Pradhan Mantri Awas Yojana, which offers interest rate subsidiaries under CLSS, has been a game changer for the segment. And on top of that, we have Housing for All Mission, 1% GST on affordable homes, and priority sector lending norms from the RBI are all working together to boost the demand, affordability, and credit availability in the economy. Moving forward, we have the interest rate regime. RBI has recently slashed the repo rate by 25 basis points, making it the second consecutive cut of this year, and also shifted their monetary stance from neutral to accommodative. So this move clearly shows the central bank's intent to support the economic growth amidst global uncertainty and inflationary pressure. And as a direct consequence, banks have started cutting their interest rates. For example, RBI cut its repo-linked lending rate by 25 basis points to 8.25%. And several other banks like Bank of Baroda, Indian Bank, and HDFC Bank followed the same suit. So this reduction in repo rate and subsequent lowering of lending rate by the bank directly reduces the EMI going forward, making home ownership more affordable and attractive for many. So another key factor is the recent budget. Firstly, by increasing the tax exemption of an individual earning up to 12 lakh, this budget increases the disposable income of middle class people, translating to the increasing housing affordability. Secondly, the budget offers better tax benefit on interest and principal amounts paid on housing loan, which eventually reduces the overall cost of borrowing for people. Furthermore, the government is putting 15,000 crore into Swami Fund 2.0 to help complete the unfinished housing projects. And lastly, by simplifying the loan approval process, this budget is designed to ease the financial burden of the middle class. Moving on to the final key growth driver, we have urbanization and aspiration. With over 40% of the Indians anticipated to move to cities by 2030, India is rapidly urbanizing. At the same time, the younger generation, they don't want to rent. They want to own. Nuclear families, hybrid work setups, and improved infrastructure in tier 2 and tier 3 cities are all fueling the demand for affordable homes. So this segment is not just a social good, it's a structural tailwind story. So in this section, we will analyze the financial performance and strategic positioning of some of the key players in the affordable housing finance space. So, and here are the companies I've chosen for the analysis. Awas Financiers, Home First, Aptus Value Housing, Aadhar Housing Financiers, and finally India Shelter. So let's begin by analyzing the AUM of these companies. In absolute terms, other housing financiers have clearly taken the lead with an AUM of approximately 24,000 crore, followed by Awas Financiers with a little over 19,000 crore, and Home First with nearly 12,000 crore. If you take a look at it, almost all the companies have grown their AUM by more than 20% on a YOY basis. And just to mention, India Shelter's growth rate is mainly on account of the smaller base. So if you compare the year-on-year growth rate of all the players with that of their 3-year compounded growth rate from a period of FY21 to FY24, all of them are pretty much in line with each other. So this clearly shows the steady performance of these selected players. Now, in terms of geographical presence, with top 5 states contributing to only 56% of the asset under management, Aadhar has the widest branch network, making it the most diversified in terms of reach. On the flip side, 100% of the AUM is attributable to top 5 states for Aptus. Just to mention, this company is heavily concentrated in South India, and this can be seen in two ways. On the one hand, they probably understand their core markets really well, and on the other hand, this company is exposed to geopolitical concentration risk. Moving on to the product mix, ours has about 69% of its AUM in home loans, 13% in loan against property, and 18% in other segments like secured MSME loans. Home First is even more home loan focused, with 84% of the AUM in home loans, 15% in loan against property, and a modest 1% in others. And in case of Aptus, it stands out with a more diversified mix, so to say. 61% in home loans, and the remaining 39% spread across quasi home loans, MSME loans, and even a bit of insurance. So they're not clearly just focused on housing. Other players are much more straightforward, 100% retail focus with no exposure to MSME lending. And then there's India Shelter with 58% in home loans and 42% in loan against property. So if you take a look at their customer profile, most of these companies, as we've already mentioned, caters to low and middle income segment of the population, with a big chunk being self-employed individuals. For example, ours has 60% self-employed and 40% salaried customers. Aptus is even more skewed, 77% self-employed. And in case of India Shelter, it sets at 74% self-employed and 26% salary. So you can clearly see the trend. So moving on to the disbursement, Q3 FY25 saw a mixed bag across players. Aadhar Housing Finance stood with the highest quarterly disbursement at 20,936 million, followed by ours at 15,942 million and Home First at 11,928 million. Well, Aptus and India Shelter trailed a bit in absolute numbers. It's their year-on-year growth and compounded annual growth rate numbers that paint a clear picture. So if you take a look at it, India Shelter, despite being the smallest in size, clocked a 29.4% YOY growth and a massive 43.5% CAGR between FY21 to FY24. And that's a solid momentum for a relatively smaller book. But the real outlier here is the Home First Finance. If you take a look at the compounded annual growth rate, which stood at 53.5% over the last 3 years, which is the highest amongst the lot. So this clearly shows they're executing really well on scaling up. And in terms of Aptus, it also held its ground with a 21% YOY growth. And what's interesting here is that despite marginal decline in QOQ, its long-term growth rate has been healthy at a 34% CAGR. So in terms of profitability, first up, Aptus again shines. It leads the net interest margin at 12.94% and a strong ROE of 18.54%. So one thing to keep in mind, this higher profitability is primarily on account of the AUM mix. As we already discussed, they are not a housing finance focused company. They're also into MSME and insurance business. So their pre-provisioning profit is also the highest at 7.46%. So Home First comes close, posting the best ROE of 16.45% and the ROA of 3.45%, thanks to their linear operation and higher yield on advances, which stood at 13.6%. In case of India Shelter, it has the highest yield at 14.9%, but its PAT is relatively modest at 2,697 million, possibly due to the higher credit cost of 0.5% and a weaker operating leverage. On the other hand, Aadhar is scaling really well. 6,670 billion profit after tax, decent margins, and improving cost ratios. ROE of 16.8% with a relatively higher leverage of 3.9 times, which actually amplifies the return for the company. So, in terms of cost and operational efficiency, if you take a look at it, Aptus is clearly in a league of its own with an operating cost of just 1.94% and a cost income ratio at a rock bottom level of approximately 20%. And if we compare it with other companies like Home First and Aadhar, where the cost income ratio stood at 36%, Aptos might look highly efficient. But what we have to remember is that these high percentage for Home First and Aadhar is primarily on account of the expenditure these companies incurred on the technological front. And in case of ours financials, higher OPEX to asset ratio of 42.53% is account of their branch heavy field on street model and obviously the technological expenditure. And finally, in case of India Shelter, even though its operational efficiency is improving, it still lags a bit with the cost income ratio of 37.5% and the OPEX to asset ratio of 3.42%. And that's an area to watch out for. Moving on to the asset quality, ours holds the cleanest book with a GNPA at 1.14%, NNPA at 0.81%, and the lowest credit cost at just 0.15%. Obviously, the lower capital adequacy ratio clearly reflects the seasonality as well as the quality of underwriting. Overall, it's a well-managed portfolio. In case of Aptus, it has the highest capital adequacy ratio of 65%, and that's primarily on account of their lending profile as we discussed earlier. For India Shelter and Aadhar, they are in the middle with a GNPA of around 1.2 to 1.4%, not alarming, but something to keep an eye on. And in case of Home First, a bit of stress is showing here with a GNPA of 1.7%. This is actually the highest in the set. But given their growth focus, some kind of seasoning effect is expected. Lastly, if you take a look at the borrowing mix, for all these affordable housing finance players, term loans are the primary source of funds, making up around 50 to 59% of their total borrowings. And this makes sense because term loans offer long-term stability, which fits well with the nature of the home loan lending business. Starting with the Aavas financials, they keep it safe and simple. 50% borrowings are from term loans, 16% from NHB, and obviously they don't use any commercial papers. A large 25% falls under the other category. These are likely securitization or other structured borrowings. Home First Finance, if you take a look at it, it has the highest share of term loans at 59%. Unlike ours, they also avoid commercial papers completely. NCDs make up around 3%, NHB stands at 17%, and the rest 21% is grouped as others. Overall, it's a clean and balanced funding structure. Aptus Value Housing Finance is slightly more market oriented. They have 54% in term loans, 15% in NCDs, and 18% in NHBs, and obviously no CPs as well. Still cautious, but more diversified approach. Other housing financials have a very clear split: 51% from term loans, a sizable 24% from NCDs, and 25% from NHB. They don't have any exposure under the other category, and obviously no commercial paper exposure either. So this puts them in a balanced spot with some market dependence but also strong support from NHB. Lastly, India Shelter also shows a conservative pattern: 54% from term loans, 13% from NHB, no commercial paper, and a large 32% on the other category, possibly indicating a flexible option like co-lending or securitization. So to wrap this up, affordable housing finance in India isn't just another lending business. It's about enabling inclusion, supporting aspirations, and contributing to the overall economic growth. In summary, India's housing finance market is large but underpenetrated. The affordable housing finance segment is growing fast due to alternative credit models and policy supports. Demographies are aligned for long term momentum. And finally, key players are building moats through innovation and niche targeting. So, from a research, strategy, and investment point of view, this is a very compelling story.